Welcome back to Exponential Media. Today, we're diving into one of the most successful government investment strategies you've probably never heard of, Australia's Future Fund. Unlike Norway, Qatar, or Saudi Arabia, Australia doesn't have massive oil and gas revenues. Yet, it managed to create a multi-billion-dollar sovereign wealth fund, built entirely without commodities. How did they do it? And what can other countries learn from its strategy? Let's break it down. Before the Future Fund existed, Australia had a problem. The government owed billions in pension obligations for public sector employees, but no money had been set aside to pay for them. At the same time, Australia's national debt was out of control. When John Howard became Prime Minister in 1996, his government inherited a $96 billion debt crisis, and it was up to his treasurer, Peter Costello, to fix it. But before we go any further, let's talk about who John Howard is. John Howard was Australia's second longest-serving Prime Minister, leading the country from 1996 to 2007. He championed economic reform, budget discipline, and tax cuts. His leadership saw Australia's longest period of economic expansion, but it was his approach to fiscal responsibility that left one of the biggest legacies. Howard was deeply influenced by the idea that governments should live within their means. He believed in lowering taxes, reducing government debt, and letting the private sector drive economic growth. Under his leadership, Australia moved away from large-scale government spending and focused on long-term financial sustainability.
When I came into office, we had to make tough decisions. The country was in serious debt, and if we didn't act decisively, future generations would pay the price. Our goal was simple: get Australia back on a strong financial footing and prepare for the challenges ahead.
And he didn't come to that decision alone.
When we took office, Australia was drowning in debt. We had to restore financial discipline and ensure future generations weren't burdened with deficits.
Peter Costello served as Australia's longest-serving treasurer from 1996 to 2007. He was the architect of Australia's budget surpluses and played a key role in modernizing the country's economy. His fiscal policies set the stage for Australia's longest uninterrupted period of economic growth. Over the next decade, Howard and Costello cut spending, privatized assets, and ran budget surpluses. By the early 2000s, Australia was in a rare position: no government debt and extra cash on hand. But instead of spending that surplus, Costello had a different idea: invest it for the future. So, why create an investment fund instead of just using the money for public projects? Because Australia had huge unfunded pension liabilities. Decades of promises had been made to retired public servants. But by 2020, these liabilities were projected to balloon into the hundreds of billions. Costello's solution was bold: take the budget surpluses and invest them. Grow the money over time. Use the earnings to pay off future pension costs instead of relying on taxpayers. And with that, the Future Fund was created in 2006 with an initial deposit of $18 billion. This wasn't just about pensions. It was part of a larger global shift in economic thinking. Since the 1980s, policymakers across the West had been moving toward privatization, deregulation, and market-driven policies. One of the biggest influences on this shift, Milton Friedman. But who was Milton Friedman? Milton Friedman was a Nobel Prize-winning economist and one of the most influential advocates of free market capitalism in the 20th century. He believed that government spending should be limited, taxes should be low, and markets should be left to operate freely.
The biggest mistake governments make is thinking they can manage an economy better than the market itself. Inflation isn't caused by greedy businesses or external shocks. It's a direct result of too much money chasing too few goods. When the money supply grows faster than the economy's ability to produce, prices rise. Control the money supply, and you control inflation. That's why I argue that central banks, not politicians, should manage it carefully and predictably. But my ideas go beyond monetary policy. When governments step in, whether through price controls, excessive welfare programs, or regulations that stifle businesses, they do more harm than good. The best way to create prosperity isn't through government intervention, but by letting individuals and businesses operate freely. Lower taxes, less red tape, and fewer restrictions on trade. These are the foundations of real growth and innovation. Some say businesses have a responsibility beyond making profits, but I disagree. A company's primary responsibility is to its shareholders, its owners. If a business is profitable, it grows, hires more people, and contributes more to the economy. That's how wealth is created. Of course, businesses must operate ethically and within the law, but forcing them to take on social or political agendas distracts from their real purpose.
His ideas shaped leaders like Ronald Reagan, Margaret Thatcher, and, of course, Australia's economic policymakers. Howard and Costello embraced Friedman's principles, believing that strong public finances and private sector investment were key to long-term economic stability. Instead of spending the surplus, they invested it, letting the market generate returns over time. So, with the Future Fund officially established, the real question was, how do you grow it? And more importantly, how do you ensure it serves future generations without political interference? The initial seed capital came from two main sources: government budget surpluses and proceeds from the sale of Telstra, Australia's largest telecommunications company. In May 2006, the first deposit was made. Less than a year later, another $8.9 billion worth of Telstra shares were transferred into the fund. By mid-2007, the Future Fund had already grown past $50 billion. But politics quickly entered the picture. The opposition Labour Party, led by Kevin Rudd, proposed withdrawing $2.7 billion from the fund to finance the national broadband network, sparking a fierce debate. Critics called it a raid on the fund, while supporters argued it was a strategic investment. Ultimately, Labour pledged that any withdrawals had to generate a commercial return. Despite early controversy, the Future Fund continued expanding. By 2008, the government had created 3 new nation-building funds dedicated to infrastructure, education, and healthcare. These were also managed by the Future Fund Board, increasing its influence over Australia's financial future. As the fund matured, it didn't just grow. It evolved. It became a global leader in sovereign wealth management, adopting the Santiago Principles for transparency and governance. It expanded into healthcare, backing the Medical Research Future Fund in 2015, and later played a role in Australia's renewable energy transition through the Powering Australian Renewables Fund. By 2019, the Future Fund had returned an average of over 10% per year over the last decade, reaching $162 billion in assets, with no additional taxpayer contributions. And in 2024, the government announced a new directive, prioritizing investments in green energy and sustainable housing projects to support Australia's future needs. Now, as of February 2025, Australia's Future Fund has reached a record value of $237.9 billion Australian dollars. So, should more countries set up sovereign wealth funds like this? Should governments invest surpluses instead of spending them? Let us know what you think in the comments. If you found this interesting, hit that like button and subscribe for more deep dives into history. See you in the next one.